The Monday session initialized with a high-velocity vertical gap up. This was a momentum-driven impulse A wave that tore straight out of the opening gates. This runaway price action sliced cleanly through the previous day's high and the hourly pivot. It looked like an unstoppable breakout, and the retail trading community rushed in to buy the top of that vertical extension. This candlestick chart shows the raw tape for the Monday session on the Nasdaq 100. They were stepping into a vacuum. The moment the market breached those local highs, the order book experienced a violent structural shift, and price collapsed in a sheer drop that erased the entire opening sequence. To the untrained eye trading off raw candlesticks, this sudden reversal looks like unpredictable chaotic tape. It looks like random market noise designed to punish late buyers. Elite quantitative operators do not evaluate or trade raw candlestick patterns floating in empty space.
Institutional algorithms execute their volumes strictly against fixed mathematical boundaries. They operate on a deterministic grid of standard deviations, historical price anchors, and equilibrium lines. What retail traders perceive as a chaotic, unpredictable reversal is actually the execution of a highly deterministic, pre-calculated algorithmic matrix. To understand how this matrix functions, we have to strip away the distracting noise of the raw price action and build the institutional trading chassis from first principles. This operational framework requires three core components: statistical exhaustion limits to cap momentum, unfulfilled historical gaps that act as downside magnets, and stacked confluence nodes that form an absolute floor. These exact coordinates must be mapped and hard-coded into the system long before the regular trading session even begins. By physically mapping this rigid geometry in advance, operators calculate exactly where runaway momentum will stall, identify the precise target of the subsequent liquidation, and pinpoint where the absolute macro bottom will form. We begin by defining the absolute ceiling of the Monday framework. This line represents the H1 Quant Level, drawn at the precise coordinate of 30,918.5. This specific coordinate functions as the hourly 3.0 Keltner Channel limit. A 3 sigma boundary represents 3 standard deviations away from the mean price. In market physics, hitting this limit guarantees absolute thermodynamic exhaustion for a momentum trend. The vehicle has simply run out of fuel. As the Monday opening bell rang, the aggressive impulse A wave shot vertically upward, clearing the previous month's high at 30,828, before slamming directly into the 30,918 Keltner boundary. The moment price contacted this 3 sigma limit, the institutional algorithms instantly pulled their buy programs from the order book. Market makers initiated a massive inventory flip. They deployed dense layers of limit offers at the boundary to mechanically absorb the remaining flow of retail buy orders, while systematic operators offloaded their positions at wholesale highs. Amateur traders continued buying blindly into the structural void, assuming the breakout would continue forever. They were buying an unstable extension, completely deprived of algorithmic fuel. It was an engine seizing at terminal velocity. Colliding with a 3 sigma limit forces a total structural break shift. It instantly converts a momentum vacuum at the highs into an aggressive downside liquidation cascade. Once the Keltner ceiling rejected the advance, the market order book opened up a massive structural void beneath the price action. The downside target was a pulsing coordinate resting at 30,714. That 30,714 print was the regular trading hours close from the previous week. It represented an unfulfilled structural gap left behind by the holiday weekend. Standing between the reversal and this gap were 2 intraday support tiers: the RTH center pivot at 30,822 and the RTH central mid at 30,750. The velocity of the downside flush was relentless. Aggressive sell programs slammed the tape, effortlessly slicing straight through both local micro supports. This is the principle of target sequencing. Downside cascades do not drop randomly. They are mathematically coded to seek out structural imbalances and resolve them. The price collapse slid cleanly down the field, striking the exact 30,714 coordinate and completing a perfect tick-by-tick gap fill. Every trapped long who bought the Keltner ceiling was forcibly liquidated on this descent. Their stop losses accelerated the flush directly into the target. This sequence is a textbook algorithmic liquidity transfer. It sweeps retail capital out of mispriced assets at the top and deposits it back into the hands of institutional market makers at wholesale value. After the gap fill at 30,714, bearish operators attempted to press their advantage and force a deeper structural breakdown, but they ran directly into a macro defense structure waiting beneath the gap. The first layer was the true C fading zone, mapped between 30,570 and 30,526. Directly underneath that fading zone was the absolute baseline guardrail, the extended trading hours central mid at 30,505.84. Anchoring the entire formation was the ultimate core floor. The regular trading hours L1 support at 30,503 sat locked directly onto the 4-hour equilibrium line at 30,449. This exact formation is called node stacking. It is the precise intersection where regular trading hours anchors, extended hours guardrails, and macro timeframe equilibriums compress into a single high-density deck. The bears drove the price down past the ETH center credit, pushing deep into the true C fading zone. But the moment price tapped the 30,503 floor, it violently rebounded. The institutional size stepping in to grab those deep dips was immense. The buy programs were so aggressive that they refused to allow a single candlestick to close below that 30,505 guardrail. For institutional algorithms, grabbing volume at these master Confluence coordinates means risking pennies against a titanium firewall to secure the macro bottom of the session. Absolute market bottoms do not form by chance. They are mathematically forged where multiple temporal and structural frameworks intersect, creating a liquidity wall incapable of being breached by retail selling pressure. By plotting these parameters, we reveal the complete architectural index of the Monday session. The matrix perfectly captured the extremes, from the 30,918 statistical ceiling to the 30,503 Confluence floor. Once the lower Confluence floor proved its structural integrity, aggressive directional market orders completely evaporated. The market established an extended hours chop zone anchored around the monthly center pivot at 30,651. Late afternoon price action flatlined, oscillating tightly inside this central box. This balancing phase represents a strict mechanical regime shift. The high-velocity trend transitions into a sideways consolidation grid. Mapping the raw candlestick tape back over this grid reveals absolute alignment. The volatility perfectly obeyed the invisible chassis underneath it. For elite operators, this regime shift triggers a strict protocol. When the trend enters a chop zone, you lock your hands and scale your contract payloads down to state 0. You wait. By ignoring raw momentum and executing strictly against the structural matrix, quantitative operators survive the volatility. They preserve their capital during the chop, and they let the geometry build the traps for the next macro expansion.